Hello, and welcome back to What Would Peter Lynch Do for our latest deep dive.
Great to be here.
We're always exploring the timeless wisdom of Peter Lynch, the legendary investor. And today we're tackling something that creates a lot of buzz.
S&P 500 inclusion.
Exactly. It seems like every time a company gets talked about or actually announced for joining this elite club, its status just shoots up. The stock price, too.
Yeah, the reaction can be pretty immediate.
And that actually led one of you, a listener, to ask a really great question. They asked, what does it mean for a company to be included in the S&P 500? And more importantly, for us investors, does it really affect your investment?
It's a perfect question for today's market. Lots of speculation, lots of movement around these events. Understanding what's really going on is crucial.
So that's our mission for this deep dive. We're going to unpack what S&P 500 inclusion actually signifies using the material you sent us.
And then look at it through Peter Lynch's lens, his practical, fundamental, focused approach.
Right. To give you a clear picture, so let's start simple. The S&P 500, what is it exactly? It's more than just a list, isn't it?
Oh, much more. It's one of the most important stock market indexes globally,
Yeah.
right up there with the Dow Jones and Nasdaq Composite.
Okay.
It basically represents over 80% of the total value of U.S. stocks, roughly 500 of the biggest U.S. companies.
Wow. 80%. So it's a huge benchmark.
Definitely. It's often seen as like a proxy for the whole U.S. economy's health and the overall stock market performance.
Okay, so getting in, that's the big leagues. But it's tough to get into, right? What does a company actually have to do? Those requirements seem key to why it's seen as this elite club.
Absolutely. The criteria are quite stringent. They're designed to ensure only really established, significant, and financially sound companies make the cut.
Like what sort of things?
Well, based on the material we looked at, first it has to be a U.S. company, headquartered here. Then market cap needs to be substantial. The threshold mentioned for 2025 was over $20.5 billion.
That's big.
Yeah. And high liquidity is another one.
Yeah.
The stock needs to trade actively, enough so large trades don't just completely swing the price.
Okay, tradable. Makes sense.
And importantly, profitability. Consistent profitability. The company needs positive earnings in its most recent quarter and positive earnings over the last 4 quarters combined.
So proven financial health, not just a flash in the pan.
Exactly. And it also needs to be listed on a major exchange like the NYSE or NASDAQ.
Got it. So size, stability, profitability, liquidity, it's a high bar. Clearing that hurdle, what does that signal to investors, to the market?
It's a powerful signal. It basically confirms the company isn't just large, it's financially robust, it's stable, it's a serious player integrated into the market.
So credibility skyrockets.
Yeah. Enhances credibility, boosts the brand value, increases perceived trustworthiness. It's like getting an official stamp of approval on their success so far.
Right, the validation. Okay, now the big question for investors. How does this inclusion directly impact the stock? I've heard something about automatic buying.
That's the most immediate and probably the most significant short-term impact. It's purely mechanical, really. It triggers automatic buying from passive funds.
Passive funds? You mean those giant index funds and ETFs like SPY, VOO, those ones that just track the S&P 500?
Precisely. Their whole job is to mirror the index exactly. So when a new company gets added, the fund managers don't really have a choice.
They don't?
Nope. They are required to buy shares of that new company. They have to match its weighting in the index to keep tracking it accurately.
Ah, so it's mandatory buying, not someone deciding they like the stock. And considering the trillions, literally trillions, managed by these funds.
It means a guaranteed and often very substantial inflow of cash needing to buy that specific stock. Creates significant short-term buying pressure as all these funds adjust their holdings.
Okay, that makes the price jump make more sense. So we have the credibility boost, the passive fund buying. Are there other effects?
Yeah, there are some other maybe slightly less direct impacts. Inclusion definitely brings increased visibility and better access to capital, potentially.
How so? More visibility.
Well, being in the S&P 500 puts the company squarely on the radar of huge institutional investors. We're talking major pension funds, sovereign wealth funds, big asset managers.
The really big players?
Right. They might have rules that say they primarily invest in S&P 500 stocks, or they just use it as their main hunting ground. So suddenly the company is much more visible to them.
And does that mean more analysts start covering it too?
Usually, yes. You tend to see increased analyst coverage from investment banks, more research reports published, invitations to major investor conferences. All that can drum up more long-term interest beyond just the index effect.
Okay. And the access to capital part.
Well, that enhanced reputation and recognition, it can make things easier if the company wants to raise money later on.
Like issuing more stock or getting loans.
Exactly. They might get better terms on bank loans or find it easier to issue corporate bonds or even issue more stock. That credibility helps.
Okay, so it paints a pretty positive picture. Credibility, mandatory buying, more eyeballs, easier fundraising. It feels like S&P 500 inclusion should lead to a permanently higher stock price. But does it?
Well, the initial news is almost always seen as positive. You definitely tend to see a stock price jump.
Right, I've seen those headlines. Does it happen right away? Is there a pattern?
Yeah, there typically seems to be two main points. The first, and often the biggest pop, is what's called the announcement effect.
When they just announce it's going to happen?
Exactly. The day the news breaks, or maybe the day after. Studies, like one by Pettishisto back in 2011, showed an average rise around 8.8% near the inclusion date then. But honestly, recent examples often show much bigger immediate spikes.
Like what? What did the source material mention recently?
Okay, so Supermicrocomputer, SMCI, when its inclusion was announced March 1st, 2024. Stock jumped 21.8% that day. Huge.
Wow.
Uber, back in December 2023, saw about a 6% jump on its announcement. The material also mentioned Coinbase, a spike over 24% when its inclusion was announced in May 2025.
Incredible.
Even just the possibility can move things. Robinhood apparently jumped 19%. Just on speculation, it might get added.
So the market reacts fast and hard to the news itself. What about the day it actually joins the index, the effective date?
Right, the effective date effect. There can be some more buying pressure then, as the passive funds finalize their trades to match the index precisely.
So another bump.
Sometimes, but often, a lot of that buying pressure and anticipation is already baked into the price after the announcement. So while you might see some activity, it's frequently less dramatic than that first big announcement jump. A lot of it's already priced in, you know.
Okay, the big reaction is usually on the announcement. But here's the really interesting part, and something the source material really stressed. Despite all that passive money flowing in, this price boost is often temporary.
That's the absolute key takeaway. And it feels counterintuitive, right? But yeah, the studies and analysis we reviewed consistently show that the S&P 500 inclusion price bump, it typically fades, sometimes in days, sometimes weeks.
Really? How long does it tend to last?
One McKinsey study mentioned it lasting around 45 days, on average, before the price tends to drift back towards what the company's fundamentals suggest it should be worth.
Yeah.
It very rarely creates a permanent new floor for the stock, just because of the inclusion itself.
Why? If billions are forced to buy the stock, shouldn't that hold the price up?
It's because the act of being included doesn't actually change the business overnight. It doesn't suddenly make the company more profitable or give it a new killer product or improve its management.
Okay.
The market, over time, values companies based on their expected future earnings, their growth, their competitive position. That passive fund buying is a one-off event, a portfolio rebalancing. It's not a reflection of a sudden increase in the company's intrinsic value.
So the buying pressure is real, but temporary, and fundamentals eventually win out.
Exactly. Inclusion recognizes past success. The stock price ultimately reflects expectations of future success. The underlying business reality hasn't changed just because it got put on a list.
That makes a lot more sense. And I think I read somewhere that this whole index effect might even be getting weaker over time.
Yeah, there's some research suggesting that. A few possible reasons. Markets are probably more efficient now. Information spreads instantly. Plus, passive investing is just so huge today.
How does the size impact it?
Well, with trillions managed by index funds, the buying needed for one new company, even a big one, gets spread across these massive portfolios. It might dilute the impact on that single stock compared to, say, 20 years ago when the index industry was smaller.
And maybe traders anticipate it more now.
That too. Sophisticated investors often try to predict inclusions and trade ahead of the announcement or the effective date. They might front-run the passive funds, absorbing some of that price move before it even happens.
Can we look at another example or two just to see how this plays out differently?
Sure. Tesla is a fascinating one from 2020. Huge run-up after the announcement and leading into the inclusion.
Okay, so...
But the sources point out, yes, inclusion was a factor, a catalyst maybe. But Tesla's continued huge rise wasn't just because it got into the S&P 500. It was driven by, well, really strong fundamentals at the time, explosive growth in the EV market, hitting production targets, profitability.
So inclusion amplified an existing strong trend.
Exactly. It added fuel, but the fire was already burning because of the business itself.
Okay. And what about Supermicro, SMCI, again, the one with the huge jump this year?
Right. SMCI had that massive 21.8% announcement pop,
Mhm.
fueled by the index news, yes, but also by the absolute frenzy around AI servers at the time. Big momentum trade.
But has it stayed up purely because of inclusion?
Well, no. We've seen its stock has been incredibly volatile since
Yeah.
then, which really highlights the point. Inclusion gives a boost, maybe brings more attention, but the price is still fundamentally driven by things like its actual earnings, its competitive position against NVIDIA and others in AI, and just overall market feeling about the business in the AI sector, not just its index membership.
Got it. And wasn't there another company added at the same time, Deckers Outdoor?
Yeah, DECK. Good comparison. It was included alongside SMCI, but its announcement jump was much smaller, maybe around 3.5%.
Oh, much less dramatic.
Right. And its stock price afterwards didn't seem nearly as dominated by the inclusion event. It kind of traded sideways for a bit.
Yeah.
Shows the effect isn't the same for every company. Depends on size, how well known it was already, market conditions, lots of factors.
Okay. So inclusion. It's a significant event, creates excitement, definitely causes temporary price moves from market mechanics, like the passive fund buying.
But its lasting impact on the stock price, separate from the company's actual performance, is really questionable.
This sounds exactly like something Peter Lynch would have a very clear, practical take on, even if passive indexing wasn't the behemoth back then that it is today.
Oh, absolutely. His whole investment philosophy gives us the perfect way to think about this. He wasn't chasing these kinds of short-term market events.
What was his core idea again? The source material mentioned a key principle.
Yeah, he consistently hammered this home. The translation from the material is essentially, find growing companies and understand why they're growing. That was his mantra.
Understand the why.
Exactly. For Lynch, real long-term investing success came from the business itself, getting better, growing profits, increasing its value, not from technical factors or just being added to a list.
So, S&P 500 inclusion. How would he view that specifically?
From his perspective, getting into the S&P 500 is like, well, it's a recognition. It confirms the company has already achieved the strong fundamentals needed to meet those tough criteria.
So, it's a result, not a cause.
Precisely. It's the result of the company being successful in creating value. It's not the cause of its future value. The why it got included, the strong financials, the growth, the solid business. That's what Peter Lynch would care about, not the inclusion event itself.
So, he wouldn't be rushing out to buy on the announcement news.
Based on everything we know about his philosophy, no way. He'd likely say, look, don't buy a stock just because it's being added to the index. That's like buying a car just because it won some award, without even looking under the hood.
Check the engine first.
Right. He'd say, inclusion is a signal, sure, but you have to dig into why it got included. Is the business actually solid? Does it have good financials, consistent profits, a real competitive edge? That short-term price jump, he'd see it as market noise, something that'll fade if the fundamentals aren't there to back it up long-term.
He had that famous quote, didn't he? Something about stocks not being lottery tickets.
Yes. The translation is basically, a stock is not a lottery ticket, but a piece of ownership in a business. That's pure Lynch.
So the passive fund buying isn't like winning the lottery.
Not in his view. It's just a technical thing, required buying by certain funds. Your real return as an owner comes from the company continuing to do well after it gets in the index. From its innovation, its profits, its growth, the inclusion itself doesn't magically improve the business quality.
And what about all the excitement, the crowd rushing in on the news?
Lynch was famously wary of following the herd. His principle, translating again, was think against the crowd.
Don't just follow everyone else.
Right. When everyone's buzzing about S&P 500 inclusion and piling in, he'd worry the price is getting ahead of itself, becoming overvalued. He warned against grille, essentially, ignoring the price you pay.
So the initial surge could be dangerous?
It could be. It might be driven more by short-term traders and hype than by a realistic assessment of the company's long-term value. Buying just because of the announcement could mean you're buying at the peak right before that temporary buying pressure disappears.
So the timing of when you react to the news is crucial too.
Absolutely. He might suggest something like the source materials point. Finding and investing before inclusion might be an opportunity, but after the announcement, it might be too late.
Meaning if it's already big news?
The market's likely already priced it in, or even overpriced it. Lynch made his money by understanding its growth story, by doing the homework and analyzing the business long before it hit the headlines or became an obvious index candidate. Reacting after the news is often just chasing momentum, not investing based on deep understanding.
It really cuts through all the noise, doesn't it? His message is just focus on the business itself.
It is. It always comes back to that core principle, the one highlighted again in our reading. You must know what you own and why you own it.
Know what you own and why you own it.
Yeah. Ground your decisions in the company's real value, its long-term potential. Don't get distracted by short-term market gyrations or the mechanics of index changes. And as he also pointed out, you're not going to beat the market just by buying the index itself. The edge comes from analyzing individual companies.
That brings so much clarity. It can feel like chaos when these announcements happen, but his perspective really grounds it.
It really does. It reminds us that genuine, lasting value comes from the company's actual skill, its execution, its business success, not just from getting a medal, so to speak, for joining the club.
Okay, so let's try to wrap this up then. S&P 500 inclusion. It is a significant event. It brings credibility, boosts visibility.
And it does cause a temporary, sometimes quite large, stock price jump, mainly because of that mechanical passive fund buying.
Right. It's a validation that the company met some pretty demanding criteria.
Definitely.
But Peter Lynch's wisdom tells us this is mostly a result of strong fundamentals that were already there. It's not the cause of future long-term value creation.
Exactly. The real focus for a long-term investor should always stay on the why behind the company's success. The business itself, its growth story, its intrinsic value.
And focusing on those fundamentals, that's what protects you from chasing these temporary market effects, right?
Precisely. It helps you avoid buying into hype.
I will say a word from Lynch today, and I will say that this principle is connected to wisdom in life as well as investment decisions. That idea, you must know what you own and why you own it, it's about understanding the substance, the real reason behind success or value, not just the external markers or awards. That applies everywhere, doesn't it?
It really does. Substance over status.
So for you, the listener, when you see companies making headlines for S&P 500 inclusion, whether it's an SMCI, an Uber, or the next one coming down the pike, maybe pause and ask yourself, can you really differentiate between a company that deserves that spot because its underlying business is strong and getting stronger versus one that's just getting a temporary lift from the market mechanics of the event? How does focusing on the why, the actual business, its competitive position, its growth potential, protect you from getting caught up in that short-term noise and maybe paying too much just as the party's ending?
It's a crucial filter for making sound long-term investment choices.
See you next time. This was What Would Peter Lynch Do? Thank you for joining us today. Have a nice day.